Ladies and gentlemen, on the crypto space, we're live on Wednesday, September 18th at 11:47 a.m. Fed day. They are certainly going to cut rates. To what extent? Who the fuck knows? Anyone who thinks they know does not know. Market odds are contrary to what the economists are saying. And basically, my perspective is I don't give a shit. So it's irrelevant. Speculation is irrelevant. And my entire mentality must further become as robotic as possible because, as much as humanity is a beautiful thing filled with emotions and sentiment, and that gives us our purpose, that gives us our drive and our ambition, our motivation, the why we do things is important. But in actually doing things, the sentiment is mostly not useful and dangerous in our capacity to make rational choices, rational decisions, which ultimately has absolutely nothing to do with emotion. In theory, quantitatively, is how we should be responding to what we inspect in markets, how we manage our finances, how we finance expenses and liabilities. It should be mathematical, quantitative, the balance sheet. And the more you're able to compartmentalize the reality of being a human with the emotions and the construct in which we exist that really warrants that emotionless type of engagement, the better one you're going to serve yourself mentally, your well being, and the better results you're going to have. So that's just something I've observed as I've gotten older. The beauty of humanity versus what it takes to actually do well as a human, to perform well as a human, to get onto the human scoreboard. Because technically, why not? You can inspect this entire thing we call reality in terms of a video game, in terms of a scoreboard, complete with points and badges and level ups, so on and so forth. So, video game is an emotion. A video game is just how many damn points you have and how well you play the game. What's your skill? What's your rank? So on and so forth. So, as I said, the better you can compartmentalize that, the better you're going to do. So, who gives a crap whether it's 50 or 25? What is pertinent is half of everything the market speculators believe 50 basis points. The economists believe 25 basis points. Warren won 75 basis points. It's the reality that what significant percent, double digit percent of the market is offsides. They've either oversized their bets or they bet in the wrong direction, which is going to cause the obvious result volatility. And that volatility goes up or down. Being rational here, folks. There's no such thing as, oh, the market's going to go up. Interesting when I say market's going to go up over time. Is that a sentiment or is that merely an inspection of the way the system mechanically works? It has been the case for a long time that we've discussed the reality of debt refinancing obligations and that it's not going to happen reasonably at these elevated interest rates. So the politics indicates that rates need to be lowered to facilitate debt refinancing, which is also contradictory to the fact that in order to incentivize the purchasing of debt to finance deficit spending, you need elevated rates. There's a tremendous amount of debt coming online. And if you want people to buy it, you've got to give them a good incentive, which is a higher rate. So the quagmire is as the rates go up, more and more of government receipts are being allocated to servicing those debt obligations. So it's catch 22 all over the place, which implies that there's no certainty in their actual behavior, other than the fact that we know that it needs to be refinanced, because the ultimate certainty is that social civility will be financed, which is exactly why a rise in unemployment causes such a dramatic change in regulatory behavior. They need to ensure that people are employed because that creates our sense of normalcy. I've talked about the story of Occupy Wall Street and any type of financial protest. If you have to wake up in the morning, or I guess you could say the luxury of waking up in the morning, and nowadays the numbers have changed. Let's say it's a $200,000 a year job in a relatively good situation state. Let's say something rural, Idaho, Kentucky, making 200 grand a year. Are you getting up in the morning to protest about unfair pay? No, you're okay. Let's say New York, you're making 350,000 dollars a year. You're not getting up in the morning to protest. So, in so many regards, social civility is is a manifestation of finances and compensation. That's literally, isn't that obvious? So it's the persons that don't have access to that kind of compensation that are protesting the absence of what they need in order to not protest, an incentive to not protest. And the regulators respond, okay, great. We need to increase money supply so that companies can borrow more money and roll over their debt and expand operations. They can borrow to create an R&D facility or purchase more goods and services and create manufacturing facilities and more jobs and finance the labor required to make all of that happen and to retain that labor because labor is a competitive thing between companies and frankly between countries as well. So that civility is required for this whole thing to work. And that requires lower rates. And we'll see what happens because if they're lowering rates and they're going to issue how many trillions of dollars, not just in deficit spending, but in refinancing obligations, of which the inspection I had this year, maybe late last year, was about $10.8 trillion needed to be refinanced this year. People around the world are probably going to want a higher interest rate, which is exactly why the interest rates have been up as high as they've been on the long end 10-year plus treasuries. Now, obviously, there's plenty of reasons why everyone wants treasuries, no matter what the interest rate is, because irrespective of a rate of return, talking about a collateral instrument that facilitates leverage, so on and so forth. And, talking about one-to-one leverage, you're putting up $10,000 worth of long duration treasuries, you're probably getting a multiple of capital, and that's the whole Eurodollar market. So we get all of these pushes and pulls in the economy based on the various pressures in the system that are created by monetary policy, primarily, but also regulatory decisions, and especially debt refinancing obligations. And probably the best thing to say right about now, we're finally gotten to the point where we're going to see some shit happen. They've been waiting to see some shit happen. And everyone's like, shit going to happen to the downside or to the upside? And that's where I take it the only step further that I can possibly take in maximum rationality engaged. I don't give a shit whether it goes up. All I know is that over time, as a human, uh, what do we have? What are we? Who are we? Hmm. We obviously have our self, our beliefs, and our mind, our ideas, our creativity, what we produce, but we also have what we own. And that's maybe a relatively modern concept, modern as in clearly the last 10,000 years. I guess property ownership and how a society protects property ownership maybe goes back to like serious old time. I'm talking about not prehistoric, like 65 million years ago. It's a much more or less civil type of existence back then. But at some point, an extension of who we are became what we own, what we choose to own. It's a manifestation of our personality. It's like, are you an Android user or an iPhone user? And people really take that shit seriously. They're like, oh, this guy really likes iPhone. Oh, look at that piece of shit Android over there. Hey, that gets hostile. What people own is very much an expression of who they are and what they believe in. You look at everything, cars and home. What? It's all a giant dick measuring pissing contest. Just let's be honest about that. So what we own is ultimately meaningful, and it's an entire conversation about like depreciating assets, cars, homes are supposed to appreciate, and they have been. But what is depreciating versus what's appreciating, and what is good ownership, what is bad ownership, so on and so forth. But what we own is meaningful. It's an expression. It gets perverted. Artists is, I mean, they can clearly create perverted expressions in art, but it still is an expression. So, as much as ownership of items can be a perverted expression, it's merely in the eye of the beholder, still just an expression. So, that's something I've been saying lately to you guys. It's what do you own? What does it mean? What does all of this mean? What you choose to own is meaningful. And and that's just a very high level thing that I keep coming back to because I know as this market starts to get weird, that's when the amateurs and the novices come out and they're buying things. So buying doesn't imply ownership. It implies a frantic attempt to keep up with what everyone else is doing. It's like fads and not memes, but it's like it's that virality, like, oh, the new trend. Oh shit, crypto's popping off. I gotta buy it also. So they're not owning because they don't have this they haven't had this rich conversation or this rich analysis. What does it all mean? So I make something deep out of what most people trivialize. Oh, invest in crypto. I buy crypto. No, motherfucker, I don't buy crypto. I don't invest in crypto. I'll own this shit. That's back in the day, back in the 80s and 90s, own it. That was a big phrase. Like own your loss, own your wins. And that's like there's an emotion associated with that expression. So it's a very personal expression when I say that. At least that's what I'm trying to convey. What do you own? What is meaningful to you? And that's the sentiment that I have at this point in my quote unquote career, in my capacity as a investor, as a fiduciary. What do I own? It should be meaningful. So trade all you want, I guess. But that shit ain't owning. You gotta love what you own. And that really comes back to a lot of things like cars. They bought such in vanity and they're so temporary. Some people love their cars. They get their Shelby Mustang, and they're like, oh, this is my baby. Okay, great. There you go. Now that's a reason to own something because you love it, like antique car collectors. That's owning. Driving a brand new 2024 Escalade, that motherfucker's going to be traded in 3, 4 years. Okay? When you got that classic 60 something Shelby and you've had it for 20 years, oh, there's some passion in that. There's some pride in that. Or you got that 1970s house that's been rebuilt over and over again in the middle of a relatively populous area, but you got that old school house. I don't know. You know what I'm saying? It's like you own it. It's your legacy. It's your the expression of your personality. You got paintings on the wall, same old shit. Maybe this is best expressed in terms of art. There's some that's really a beauty is in the eye of the beholder type thing. Um, in any regard, that's the biggest takeaway on Fed Day. Nothing matters. Nothing. So fall back on the base reality of what it means to be a human and think about emotions and their significance and this process in which we engage, what are assets and what is owning things. And don't drive yourselves freaking nuts. The last thing I expect anyone that has rigorously listened to me over the years to do is to engage frantically in markets, especially as they start doing weird shit. What is weird shit? Do folks not remember 2020, 2021, 2016, 2017? And other periods as well where you get parabolic moves. I mean, seriously, you got 10, 20%, 30%, day in, day out. Oh, it's just up, up, up and to the right. It does. It's like, is it ever going to stop going up? And then you're like, jump on board. No, you should have owned that shit before it stopped going up. So it was a good thing to own. It was meaningful. In this world of shit, world of corporations that own everything, in this world of accredited investors, protecting the investor. You can't own shit outside of the crypto markets. You own shit in equities land. Well, nothing. Anyway, I just talk about that a lot. Warren Buffett always said, "Oh, you're not buying stock, you're buying a company." No, you own shit. You own nothing. Oh, I own shares that are positive. Brokers, like if I own whatever. No, what is ownership? What is ownership? It means you get something for what you own. You have a car, you get to drive it. You have a house, you get to live in it. If you own a business, that shit better pay you. That's what it means to own something. You get something for it. I own a phone. You're using the phone. It's technology. If you own a stock and it's not paying you, that's not owning shit. That's gambling that other schmucks are going to buy the shit you bought after you. Anywho, I talk about the same topic over and over again. If you're on X or on YouTube, throw some questions or comments into the stream. We'll flip through a couple of charts. We'll say hello to the commenters, and let's get this show on the road. Not a bad intro. I've done. Arrow, good morning. Say good morning, A. Smith. Good morning, boys. Metal in the house. Captain Cap Rational strikes again. I can't help it. Now the thumbnail, yeah, right. How's it going? This is the journey, and there's some free pick nowadays. It's just wild stuff that we got. Anywho, Crypto Two. Good morning, Cap. Don't fight the Fed. Well, it's not about fighting the Fed. We know there's contrarian pressures in the system because if you're lowering interest rates, that means if you borrowed in a cheaper currency and the spread between interest rates of countries is narrowing, it invalidates some of that carry trade, especially if the breadth to the upside in US equities rolls over for a bit. So that is ultimately an expression of capital moving offshore, or at least capital moving out of concentrated positions into more at the margin positions, or at least the contrarian play. If everyone's concentrated into something, the contrarian play is where's capital absent? Yeah, it's pretty much industrials and commodities and stuff like that. Manufacturing in the United States completely absent. Certainly do not have much of that, do we? So that is one pressure, and then the other obvious pressure is an expression on the DXY because as you cut rates, the dollar comes down. That is the mechanics of how it works. So I mean, I got to look up here. Actually, we have it. So I need to normalize it though. So this move to thin scale pin to Pinch new rate scale. Okay, there you go. Want to have two scales. And okay, so you cut rates. So when you cut rates, the dollar comes down. I mean, broadly, that still holds true, which is quite the contrary with regard to the inverse correlation we're seeing expressed in equities uh, and debt pricing. If you look at the 10-year versus the S&P, it's basically an inverse correlation with rates, which that's just the weirdest thing post 2020, but that's what the economic folks. It makes a lot of sense. But generally speaking, as Fed funds comes down, the value of the dollar comes down. Fed funds went up in '04. Oh, but man, the dollar kept going down. So that's a weird one right there. That's a bit of an anomaly. But look about heading into 19 as they started cutting rates in 19, and then the dollar took took about 6 months. So that's the leading indicator. Fed cutting rates is the leading indicator. You have to look at the bond volatility index, the move indicator, as well as yields in order to really inspect. I personally see Fed funds as a lagging indicator in many regards. So, point being, rates come down, the dollar comes down. But what's most interesting right about now is look where we are in dollar pricing relative to interest rate cuts. Back in 18, we were pushing up, up, and up along with interest rates, and then we had a blow off in March, April 2020, pushed right through Fed interest rates, and that's where we are right about now, structurally in many regards. They just haven't cut yet, so maybe this was the blow off right here, broke everything back in October 22, and then they didn't cut. That's fascinating. How did the dollar fall from October 22 back to the less than 110 range without a Fed cut? In fact, they literally just started tapering off interest rate hikes. So that means all the mechanics are in play. And this is probably deficit spending. This is probably treasury buybacks, which certainly didn't kick in yet back in 22. That's more recent. So this is that geopolitical collusion that we've talked about, where they're deploying every mechanism and facility possible in order to ensure smooth market function of currency and debt markets, which puts us in a very interesting position. So those facilities have managed to depreciate the dollar down from 114 to 100, right above the moving average, without rate cuts. We could see significant weakening of the dollar, and that would be very meaningful from especially a crypto market standpoint, because typically we see a correlation, or rather an inverse correlation, with the dollar and crypto market. Dollar goes down, when the dollar goes below this 200 on the weekly, that's your bull markets, ladies and gentlemen. Now, that's not something that's going to inversely correlate, because that's not the base mechanic of the system. When the dollar weakens, foreign currency appreciates. There's much more foreign currency on the planet, which is ultimately results in significantly increased purchasing power around the planet, increased quote unquote liquidity conditions. And that's why your bull market is when DXY broadly goes below the 200 on the weekly, which is your red line. Bull market back in 16, 17, because you had obviously your collapse from the blow off in December of 2016. And then your second leg was when it broke below the 200. So this move from 114 to 100 is probably your repricing of Bitcoin and Solana move off the bottom, and your frenzy of activity in Solana meme coins and your airdrop madness on Cosmos hubs, and that caused a lot of activity. But that's not quote unquote meat of the move. That's a normalization process. process. The average is really below this average where the interesting stuff occurs. You don't know what's going to happen in a return to the mean, everything reappreciated. And then you get at the margins, outsized activity, which is what I just described, post 2024, a lot of memes, Cosmos type stuff. Repricing of Bitcoin certainly returned to mean, which is fascinating given that we're at $60,000. But when you go below, that's when you start to see what is really meaningful. That's more of an investment driven capital flow situation because you have significantly more capital and the larger actors are not speculating on bullshit memes. It's not speculation, it's more just capital transfer from the uneducated to the educated. And I don't mean that in like a good sense of education. I mean that in a manipulated, just a qualified grifter sense. The word educated, I guess, that's a decent expression. So we're right here across the board, including on the moving indicator, man. They're going to cut rates. The fact that we're below the 100 on the weekly moving average on the volatility indicator, I don't know. I don't know. But they're about to cut rates, and that is probably the way this responds as well. Broadly, like, eh, I guess this was a divergence in 15. Volatility was coming down and rates started to go up. And maybe that's what caused the policy error that blew everything up in March of 2020. Because obviously they're cutting rates here and the volatility is collapsing back. Wait, that was a relatively short-lived chart. It's less than like 40 something years. Be nice to see this a little bit further back, but the moving indicator didn't exist back then. So they're going to cut rates between treasury buybacks and DTCC and what have you. Volatility in the debt market's going to come down. Those cycles will cycle. This is just a natural law. So we have a confluence of confluence stacked in the favor of these markets having or experiencing outsized depreciation. Gold at 57.70. So weird. It's like you're looking at the twilight zone. Oh, what a world to live in. You even see some of these correlations or even understand the way the mechanics of these systems work, the pressures in the system. So damn weird. Okay, let's keep going down the comments. Interesting take from Elon. Buffett's cash position is the hedge of Kamala win as that likely collapses markets, he says. I have a lot of political opinions. Obviously, I like the way Buffett thinks. Having a large cash position gives you optionality. It means buy whatever the hell you want. So that boy is clearly at the end of his investment cycle here as human. He's getting old, but he's still got it. He still gets it. Still cash positions. That's the most important thing, cash buffer, because with cash you can make choices. But the problem is cash 22 is you need productive business in order to build cash. So I think his greatest offering, the highest of level to society from an investment advice perspective is buy when shit's cheap, because he says all this. So you got to start somewhere to beat the chicken and the egg. So you got to own business and you got to have cash. You can buy business with cash. So once you start buying the businesses produce cash and you're accumulating cash. And then you're buying more business. So that there's your cycle there. So I guess the entire breach of the chicken and the egg starts with the allocation of capital to buy productive business. And then over time, that builds and spirals. And then the difference between the destination for investors is choosing the businesses that outperform. And that's no easy thing. Um, Fortunately, I think there's great opportunity in these crypto markets as compared to equities markets. I mean, he literally owns businesses in equities markets. When you own double-digit percentages on the bank, you are not the average investor. You are sitting on the board and you are getting paychecks and dividends and meaningful capital as a majority shareholder or whatever, minority shareholder, whatever the classification and terminology is. You're no peasant getting 0.025% interest rates. You're getting a different deal. And nobody's doing that with 5 shares of Tesla, 10 shares of Tesla. But in the crypto markets, that's the case. So that's why I prefer to own these instruments. Own cash flow, build cash. This bull market's going to rage, build cash. Don't buy anything when it's going up. You build the cash on the way up. You sell it on the way up. It's really exit liquidity season, as I'm starting to really appreciate it. And then as everything crashes, you structurally look for a top in the move indicator. You structurally look for an absolute explosion in DXY. Maybe things crash to like 95, or dare we say like a 90, and then it blows up to 100. And then things get under control. And then you start to see things like Fed balance sheet, like start to top. And and that means maybe they're buying less. Maybe the breath rolls up. Because obviously, look at this leg. You had a massive leg of buying in 2020, and a second leg in July. And then that shit shows how slowed down. And frankly, that's awkward, or maybe it's not, that there was literally an inverse head and shoulders in Fed balance sheet. So it's like they ran out of breath to the upside. They're like, we're going to slow this down. Oh, but then they needed to acquire a little bit more. And then they're like, yeah, we got normalized. And they started offloading. So maybe as much as it's not an organic price action chart, maybe it does express the same fundamentals of financing, which is the fundamentals of nature, which is if you're not going to be buying, probably indicates people are thinking about offloading. There's plenty of reasons to offload as well as buy. Um, so you see outsized moves basically in DXY move, Fed balance sheet. You'll see outsized moves in VIX, which would be like a crash in the SVIX. I just follow the SVIX because I find it fascinating that you're above at least, I don't know, you're getting back above the 100. It's a brand new asset, 2022. Really just don't wonder why this came from 2022, but that's another story. So you see this spike, VIX is going down, but you see this crash, and there you go. There's your outsized volatility event in equity markets. So we have a much better sense historically now, especially with hindsight 2022 to 2024, of when to start buying. Certainly could have waited. I think arrows on. Yes, you are. Oh, we certainly could have waited a little bit longer, couldn't we? So, okay, hindsight, great. Could have waited a little bit longer. Could have acquired at cheaper prices. Back to Buffett. Build cash on the in the bull market when everyone's absolutely out of their minds, thinking the way everyone thinks, and not as the contrarian. Stack it up, piles and piles, and then when everything completely explodes, identify market characteristics expressed in technical data that indicate decent bottoming. All my power, obviously, get a little sense. But that's a little bit of a slower moving chart, I guess. I guess maybe not, because his data, it's not real time. His data expresses that there was a bottom in liquidity conditions, basically in Q4 2022, which we would see in the move indicator as well. Bum, bum, bum. You had your blow off in March of 23. That is a bit of a lagging indicator for that. Let's zoom out a little bit. Huh. So, well, maybe that's here's yeah, okay. From a monthly perspective, there's your top, October 22. And then boom, and there goes liquidity to the upside because volatility collapses. And this final candle is just nailing the coffin from a technical perspective. Transitory March of 23. Oh, look at these dates. Liquidity bottomed in Q4 22. Bam. What happened in March of 23? US banking system failed. And well, that shit would have been an absolute financial cascade, so on and so forth. And so it failed. Same as September of 2019. Banking system failed. March of 20, different reasons. That was, repo meltdown in September 2019. Folks don't really talk about that, do they? Folks don't talk about March of 23 that the banking system failed, but it sure as hell did, ladies and gentlemen. That's right here in the technical data. Suppressed volatility, suppressed, and now back to the downside. There's your top. Not really a forward-looking indicator, though. How are we on the forward-looking? That's a lagging indicator. So markets really did some weird shit back in May 2020. So June, July, August, and then August it really took off until the end of the year. Where's the year? Kind of, I remember markets get a little frisky in January 21. And into the end of the year, it was straight up until December that it was markets were under pressure. Correctly, sounds about right. Anywho, it's always good to get a sense of what's a leading indicator and a lagging indicator. But in any case, DXY move at balance sheet, standard shit that everyone's been talking about for the last years at this point. Hope that helps. Good stuff. Arrow, your tweet, I'm clicking it. The tweet up until the end of the year, next part about I don't think the rule sounds great right now, given how down only all coins are. Yeah, I mean, we're under pressure. We're in the final stages of austerity, in my opinion. Clearly, that's also hope, but that's also just uh, general inspection of market structure. I mean, obviously, if austerity has occurred to such a degree, we're probably getting towards the end of it because it's not just austerity for us, dude. Crypto market. Talking about austerity for everyone in the general public sentiment that we know all too well. Nobody got 30% pay raises since 2020. So that's means the system is due for a cycle. Gives people a little bit of a break. And that's where we are. I mean, I literally had to spread my votes around this week between like 5 or 6 things. Not on V33, V33, those remain relatively concentrated. Very nice productivity. Ramsey's did the best out of all of them this week. Nile trailed Ramsey's just by a little bit, but between Ramsey's and Nile, ooh, it was a hell of a week. And between Ramsey's and Nile, yeah, I literally, relative to cost basis, it's a hell of a week. Uh, Relative to cost basis, 80%. That's pretty cool. Relative to cost basis, this week was an 80% APR week. And that's including the absolute disgusting depreciation in both Cleopatra and not. So it's fascinating. We'll see how this plays out over years. Is it something that's owned? 80% basis, cost basis, not like current depreciated price points. So that's fascinating. Anyhow, so things remain productive still. I had the spread amongst like 5 or 6 different things between boat market and Warden, and I don't know. It should be a decent weight. We nowhere near all-time highs. Oh dear God, that's like 80, 90% collapse in revenue. But I said that a long time ago. If you experience like an 80, 90% portfolio collapse, and in this instance also like an 80, 90% collapse in revenue, and you're still like, all right, still pretty damn good. That surely sucks. It's disappointing to a degree, but that also means you did something right. It means you made better than worse choices because most people Unfortunately, lose everything because they make bad choices. So all you need to do in these markets is be a little bit right. It's when you're a little bit right and something is big as this, that has very big implications. That's pretty much a very important observation. Just need to be a little bit right in crypto, and we clearly are. That's right. Uh, so yeah, it does sound great right about now. I please, yeah, things have gotten tight. I haven't had a pay raise since 2020, so I'm operating on basically a 25% reduction in salary relative to purchasing power, and that has been offset by capital that my business owes me, and that is makes balances the books. Everything's covered, so that's in terms of wake up money. So that's why the captain's always in a good mood because the captain has wake up money covered gratefully. But man, yeah, I cover wake up money. Ooh, oh, how much else? We're getting close to where we get to have a little bit more cheer in the air about. All right, that was a weird week. I look forward to weeks like that, where it's like, oh shit, that just really occurred. Say distressed assets. I guess that's the point of what I mentioned earlier when I was saying to Arrow. Probably could have waited a little bit more. So all of this is critical experience. Now it's imperative to learn from experience, which means what are you going to do in 2027, 2028? Bet you're going to do it differently next time. Okay? So don't worry. What matters is you survived the last couple of years. What matters is you didn't lose everything. What matters is that 80, 90% drawdown, you're like, oh shit, that's what I got left. Nice. Is it more than 2019? Oh, nice. Relative. Measure relative to meaningful time frames and rational types of inspections. What's your CAGR? Compound average growth rate. What's your CAGR? Calculate your CAGR. You had X amount of capital in 2019. You have X amount of capital today. Go on AI, pick on ChatGPT, calculate your CAGR. Okay? If your CAGR is greater than 12%, you are killing equity markets. Just remember that one. Chin up, and you made it this far. Uh, Present and account for. Sir, yes, sir, Joe, sir. I got issues. Uh, Crypto tube, are you treating cash as Bitcoin currently? No, I treat Bitcoin as cash. Oh shit, that's deep. um, I treat Bitcoin as cash. It's a collateralizable cash equivalent in most regards, clearly more volatile than other collateralizable cash equivalents. That's my general framework. Collateralizable cash equivalent. Last thing I ever want to say. You can borrow against it. That's meaningful. I got to see where this shit ends up. So pick your number, own a quantity. I wish there was a user interface that used the Bitcoin lock function. Literally, no one uses that shit. It's beyond me. They talk about never selling it, and literally no one uses the actual Bitcoin lock function. Bitcoin literally has a lock function. Nobody talks about it. I'm the only one who talks about it. The Bitcoin maximalists probably don't even know it exists. I'm more of a Bitcoin maximalist than the most maximalist of maximalists. What the fuck is with that? That's insane. Lock your shit. Check back when the end game approaches. And that's the whole point of owning it. Clearly, nobody wants to own Bitcoin for a 2x or a 3x money. Turn $1,000 into 3 grand. That's jack shit for your net worth. That's all you're probably going to get for Bitcoin over the next 4, 8 years. And then the whole speculation is the end game when you get the Weimar event. and it goes 10,000x on the money, and gold is demonetized, and all the stuff that everyone talks. So you got to have some of it to see what plays out. So that is my general sentiment with it. So whatever that number is, that's something you choose. That's a subjective choice. But own it. Bar against it as warranted. Make sure you have businesses that can finance that debt. Don't overextend your leverage. And then all of that makes sense. So it's a component of the portfolio. I define it as a component of the cash position of the portfolio. And when I say define it, guys know I sure as hell define stuff very explicitly, very rigidly. Not much discretion in my framework, which is quite interesting. Hope that helps, dude. A suit in the house. Good morning, Cap. Always a pleasure, everybody. Ladies and gentlemen, let's take a peek. 59,760. So here's the time frame that probably is most interesting for Bitcoin weekly chart. Bullish cross of the 100, 200 is the first dip below 200 of for the 100 ever. I mean, literally ever for Bitcoin in the weekly. Fed funds irrelevant on this chart. 50 SMA mean regression thus far. Like literally, that's all it was. All of this mean regression was to the 50 SMA. And look, boom, boom, boom. Everyone's freaking out. Oh, Bitcoin's going to 40 cents. No, it clearly has not, and is not likely, considering one, two, three pretty meaningful interactions with the 50 SMA. Albeit, where are we from the top side? Is the strongest expression of resistance thus far by the weekly 10, which is meaningful. Breach, rejection, breach, rejection, breach, rejection. But now, going on 2 weeks of much stronger rejection than anything we've seen since the top of March 24. 10 SMA is expressing greater degree of resistance currently. So that's where we are. Don't drive yourself nuts over this shit. I think it's a lovely looking chart. If Bitcoin is above 39,000, it looks pretty cool. You see a mean regression down to 40,000, you're like, it's down to 40,000. It's above, it's a moving average. It's literally a mean regression. That 200 is quite telling how deviated from. Anywho, I hope that helps. Right now, 25 cents. Oh dear, painful to watch. Everything taking a hit, Nasdaq, S&P, but S&P hit all-time high yesterday. Obvious pullback at the top, but there was a brief all-time high yesterday. Nasdaq is literally just insane chart. Passive flows, boys and girls, 401ks. That's some crazy shit. What they created. 2571 on gold. Wild. Aave at 135. That's cool. Russell 2000 haven't reached all-time high since 21. See what this thing does. Very interesting. Anyway, 2:30 Eastern, I believe, and FOMC. We'll probably have notes out before that. I'm sure it'll hit the rounds on social media. Cheers to 25 basis points or 50 basis points. Who cares? All that matters is the dollar weakens over the next 10 years, and we get to see a cycle. Lower highs and lower lows. The dollar appreciation, cyclical appreciation of foreign currency along a secular trend. First secular trend shift since 2008. So I want front row tickets to that show. And I believe that's what we all want, whether we could say it in those terms or not. Front row seats, baby. Strap in. Wednesday, September 18th, 12:36 p.m. 139 people made it to the end of the stream today. I wish you all a good one. Stay rational, stay calm, cool, collected. Got this. Got this. I will see you again on Friday. Peace.